This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, July 20, 2026, and this is the After Hours session. Now, let's get into it. Markets are in a state of extreme distress right now. The Fear and Greed Index has crashed to 14 out of 100, a reading that screams capitulation. Gold is surfing at $4,025, and the dollar index is pushing higher while risk currencies like the Australian and New Zealand dollar struggle to find footing. Welcome back to ShadowQuant Forex Edition After Hours. Looking ahead, the calendar is notably quiet. There are no major U.S. data releases scheduled for the next 48 hours, meaning we are in a digestion phase for the weekend's geopolitical shocks and the latest inflation prints. The next significant catalyst arrives on Thursday, July 23rd, when we get the U.S. weekly jobless claims report. That will be our first fresh look at labor market fluidity since the geopolitical escalations began. And then, on Monday, July 27th, we'll see the dollar GDP now estimate update. Until then, the market is running on headlines and flow data alone.
And that silence on the data front is precisely why the existing positioning becomes so dangerous. With no new fundamental anchors coming online, the crowded yen shorts and the safe haven bid in gold become the only narratives driving price action.
So, let's set the board. We are seeing a broad-based strengthening of the US dollar, with the index sitting at 120.53. Safe havens are leading the charge. Gold is up 0.74% to $4,025.13, and silver has pushed to $57. But the real drama is in the crosses. The Australian dollar is hovering near its lows at 0.69942, and the British pound is struggling to hold momentum at 1.3462. Meanwhile, the US-Japanese yen pair is clinging to its highs at 162.368, despite a slight intraday dip. The VIX is up 2 points to 18 point, but it's the Fear and Greed Index at 14 that tells the true story of the mood. Why is the dollar still winning when the yield curve is flattening and geopolitical risk is spiking? Pulse, walk us through the macro disconnect.
It's a structural disconnect. The Federal Reserve has maintained a higher for longer posture. The Fed funds rate is locked at 3.63%, even though the 10-year, 2-year spread has flattened to plus 0.39 percentage points, which usually signals recessionary fear. The Fed isn't budging. Why? Because inflation is sticky. CPI is at 3.46% year-on-year, and core PCE is at 3.41%. Both are well above the 2% target. So, despite growth slowing, real GDP is just 2.09%. The central bank is prioritizing inflation control. That keeps real yields elevated and provides a bid for the dollar, even as equity markets wobble.
But this higher for longer narrative seems to be colliding with a massive positional bet in the yen. CIPHER, the flow data here is extreme.
Extreme is the right word. Leveraged funds have accumulated a net short position of negative 90,461 contracts in the Japanese yen. That is a massive, crowded trade. Week over week, that short position grew by nearly 92,000 contracts. It's a momentum chase. These funds are betting entirely on the widening interest rate differential between the US at 3.63% and Japan, where policy remains dovish. But look at the euro side. There's also a net short of negative 53,691 contracts in the euro. Smart money is piling into the greenback and dumping the yen and euro simultaneously. The flow is undeniable, but it's fragile.
Let's talk about what's driving this risk-off sentiment. First up, U.S. launches new Iran strikes again Monday as Saudi coalition warns Houthis with force. This is the headline moving the metal. How does this impact the currency desk?
It explains the gold bid. Gold is at $4,025.13, up 0.74%. But more importantly, it validates the extreme fear reading. The Fear and Greed Index at 14 is reacting to kinetic conflict. When you have active strikes in the Middle East, Capital flees rate-sensitive assets and hides in dollar and bullion. It suppresses volatility in equities. Look at the VIX, which is manageable at 18.77, but it spikes actual spot FX volatility. That's the danger. The VIX is lying to you. The real risk is in the cross-currency spreads.
Second headline, Fed's hammock makes closing case for higher rates before blackout begins.
That reinforces the status quo. Hammock is essentially telling the market that unless inflation data breaks below that 3.41% core PCE mark, we aren't seeing cuts. He's closing the argument before the blackout period, which removes ambiguity. Markets hate ambiguity, but they hate uncertainty about rate paths more. By clarifying that the bar for easing hasn't changed, he's removing any hope for a near-term dovish pivot, which sustains the dollar bid I mentioned earlier.
Third headline, Trump hits Canada with new tariffs on alcohol, dairy, and autos.
That introduces a structural drag on the Canadian dollar, but we don't have dollar CAD pricing in the table right now. It's not active in our verified stream. However, it feeds into the broader risk-off theme. Tariffs increase uncertainty, which hurts export-oriented economies. It contributes to the pressure we're seeing on the Kiwi and the Aussie as traders anticipate slower global trade volumes. It's a secondary factor, but it adds to the headache for Aussie and Kiwi.
Finally, New Zealand Q2 CPI 4.1% year-over-year, expected 4%, and 1.5% quarter-over-quarter, expected 1.4%.
This is the outlier. The New Zealand dollar spiked to 0.58585. This wasn't just a beat, it was a deviation from the consensus enough to break the daily range. It forces an immediate repricing of RBNZ expectations. While the macro is higher for longer globally, Kiwi is getting a localized jolt of volatility. It's not a trend change yet, but it's a sharp, reactive move.
Let's dig into the specific mechanics of the major pairs. Starting with dollar-yen, it's at 162.368, just shy of its 5-day high of 162.597. CIPHER, you noted the massive short interest. Is this move sustainable?
It's sustainable as long as the delta doesn't turn. The leveraged fund short of negative 90,461 contracts is the engine. They are adding to it relentlessly. But here's the friction. Grid, you're looking at 162.597 as resistance. I'm looking at that level as a liquidity pool for shorts. When price touches that, the margin requirements for those leveraged funds get tighter. If volume starts to dry up at 162.6, we aren't going to see a smooth continuation. We'll see a squeeze. The positioning is so extreme that a minor shift in flow can trigger a mechanical unwind. It's not just about rate differentials anymore. It's about who has to sell bonds to cover their margin calls.
And from a charting perspective, the price action is congested. We've tested 162.5973 times in the last 3 days. Each test has been rejected. The 5-day high acts as a ceiling. Meanwhile, the 5-day low is 161.89550. The current price of 162.368 is practically glued to the top rail. Volume profiles suggest that buyers are exhausted. They're stepping aside. If we don't clear that level on expanding volume, the default direction is back toward the mean.
Grid is talking about exhaustion, but he's missing the risk profile. You're treating this like a normal technical breakout attempt. It's not. It's a loaded gun. That negative 90,000 contract position is a self-reinforcing feedback loop. If price breaks 162.6, you don't get a breakout. You get a forced liquidation event. The standard support and resistance levels become irrelevant because the cost of carry becomes unsustainable for the marginal holder. The VIX is low, so people think it's safe. It's not.
Let's pivot to the other side of the spectrum. Commodity currencies. Aussie dollar is at 0.69942, down 0.22% intraday, sitting just above its 5-day low of 0.69627. Grid, what are you seeing on the chart?
It's a classic distribution pattern. Price is consolidating near the lower end of its 5-day range, which runs from 0.69627 to 0.70212. The fact that it's failed to reclaim 0.7000 repeatedly is significant. It suggests that every bounce is being sold into. The structure is weakening. We're seeing lower highs on the intraday charts. If we lose 0.69627, we open up a gap down toward the next historical support zone, which isn't mapped in the 5-day window, but the psychological break of sub 0.69 would accelerate algorithmic selling.
And the flows confirm the weakness. Despite the price dropping, leveraged funds still hold a net long position of positive 27,222 contracts in RC. That's a divergence. The bulls are holding onto losing positions. They're hoping for a rebound, but with the global risk-off regime dominating, remember the fear and greed index at 14, those longs are increasingly exposed. It's a slow bleed. The bullish thesis is failing to translate into price discovery. It's a dead cat-bound structure.
It's also a casualty of the carry trade unwinding. When you have a higher for longer Fed at 3.63% and a commodity-dependent currency like Aussie facing global growth fears, the interest rate advantage evaporates. Traders are exiting the Aussie long positions to fund the dollar short hedging. It's not just technical, it's a fundamental rotation out of rate-sensitive assets.
Which brings me to the Kiwi spike we saw. Kiwi dollar jumped to 0.58585 on that CPI beat. Don't mistake that for strength. It's a volatility event. The market was caught off guard by the 41% inflation print. Now, every trader who was short Kiwi is scrambling to cover. It's a chaotic, messy move. It's not a trend establishment, it's a stop run. In a risk-off environment, Kiwi is structurally weak against the dollar. This spike is likely to fade as the initial shock wears off and the fundamental reality sets in. New Zealand's economy is vulnerable to global slowdowns, and the RBNZ has limited room to maneuver without crashing their housing market.
Let's look at gold. Gold is at $4,025.13, up 0.74%. It's sitting roughly midway between its 5-day low of $3,959.64 and its 5-day high of $4,081.59. Is this a breakout or a range-bound play?
It's range-bound. 4,025 is dead center. The price action lacks directional conviction. We haven't broken above 4,081, nor have we broken below 3,959. The volume isn't expanding enough to suggest a trend initiation. It's waiting for a catalyst. The geopolitical headline from Iran is supporting the bid, but it hasn't triggered a sustained rally above the upper rail. We're seeing consolidation. The sellers are present at the highs, preventing a clean breakout.
The positioning supports the consolidation. Safe haven buying is present, but it's cautious. Look at the COT data for precious metals. We don't have the exact COT number in the brief, but the flow data shows that institutional money is rotating into gold but not chasing it. They're accumulating dips. The fact that gold is holding 4,025 despite the risk-off environment suggests underlying demand. But it's not a parabolic move. It's a steady climb. The fear and greed index at 14 drives this, but it's a measured fear, not panic.
And remember the yield curve. The 10-year, 2-year spread is flat at plus 0.39 percentage points. Historically, when the curve is flat, gold performs well as a hedge against stagflation. The combination of sticky inflation, 3.46% CPI, and slowing growth, 2.09% GDP, creates a perfect environment for gold to act as insurance. It's not just a geopolitical hedge, it's a monetary hedge. That supports the bid at these levels.
I agree it's supported, but I'd caution against calling it steady. It's fragile. The same forces driving dollar-yen higher are putting pressure on all non-dollar assets. If the Fed's Hammock comments lead to any hawkish surprises during the blackout period, gold could see a sharp retracement. The 4,025 level is a battleground. If it loses the 4,100 level, we could see a quick slide back toward the 5-day low. The risk/reward is not favorable for new longs at these extended levels.
Cable is at 1.34616, up 0.12%. The British pound is showing some resilience, but grid, your notes mention a contrarian trap.
Yes, the 5-day range for pound is 1.33807 to 1.35580. Currently at 1.34616, it's in the middle of that pack. But look at the structure. It's trying to expand upwards, but it's met with resistance near 1.3500. The price action is choppy. It's not trending, it's oscillating. The lack of a clear breakout above 1.35 suggests that buyers are hesitant. They're watching the dollar's strength. If the dollar index holds at 120.53, pound struggles to gain traction. Technically, it's a do-nothing setup until it chooses a direction.
And the positioning contradicts the price. Leveraged funds have added 29,099 contracts to their net long position, bringing the total to positive 28,541. That is strongly bullish positioning. But price isn't responding. It's stuck. This is a classic long squeeze setup. If cable drops below 1.33807, those longs will be forced to exit en masse, accelerating the decline. The market is telling you that the bullish positioning is premature. The price action is rejecting the narrative.
It's also a victim of the UK's economic data. Unlike the US, which has sticky inflation keeping the Fed on edge, the UK is grappling with its own stagnation. Without a fresh inflation beat to justify a hawkish Bank of England stance, the pound has little reason to outperform the dollar. The net long positioning is likely speculative, chasing a potential Bank of England pivot that isn't imminent.
Apex, tie it together. We have dollar-yen pressed against extreme shorts, Aussie/Kiwi under pressure from risk-off flows, and gold consolidating in the middle of a geopolitical storm. What is the dominant structure?
The dominant structure is a high volatility mean reversion regime. Pulse highlighted the Fed's refusal to cut rates despite the flat yield curve, which anchors the dollar higher. Grid identified that dollar-yen is hitting technical ceilings at 162.597, while Aussie dollar is hitting floors at 0.69627. But CIPHER revealed that these levels are backed by extreme, crowded positioning, negative 90,000 contracts in yen shorts and positive 28,000 in pound longs. SPECTER correctly flagged that this makes the current price action fragile. It's not a healthy trend, it's a compressed spring. The market is balancing on a knife edge. The dollar is strong not because of growth, but because everyone else is weak. The key is whether the yen shorts crack at 162.6 or if the Aussie longs collapse below 0.696. Until then, expect whipsaws, not trends.
Here's the takeaway from the Forex desk. 1. The dollar remains bid due to the Fed's higher for longer stance and sticky inflation, despite a flattening yield curve. 2. The yen short squeeze risk is paramount. The negative 90,000 contract position creates a fragility in dollar-yen that could trigger violent moves if the 162.6 level gives way. 3. Commodity currencies like Aussie and Kiwi are suffering from the risk-off rotation, with Aussie testing critical support at 0.69627. Keep your leverage low. The VIX is calm, but the FX flows are screaming. Good luck out there. This is ShadowQuant Forex Edition After Hours. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.